Hey everyone, it's Amit. So today I want to talk about special purpose acquisition corporations or SPACs, and by the time I'm done with this video, hopefully you'll have a pretty good understanding why investing in SPACs is such a dumb idea. Okay, I'm going to talk about 5 things in particular in this video. What is a SPAC? How does a SPAC work? Why are SPACs so popular? What should an investor know about SPACs? And then we'll wrap it up with what's next for SPACs. So without further ado, let's get into it. What is a SPAC? So if you look at the Securities and Exchange Commission or the SEC site, what they will basically say that a SPAC is a blank check company. So then the question becomes, well, what is a blank check company? Well, a blank check company is a company that does not have a business plan, and they're basically being created for the sole purpose of doing merger and acquisition activity at some point in the future, typically within the next 18 to 24 months. The notion about SPACs is they're purely speculative in nature, and the SEC puts these SPACs in the same bucket as penny stocks, and that is not to say that these stocks are trading at pennies to the dollar, but it has more so to say that the amount of risk that you're taking when you invest in a SPAC is analogous to the amount of risk that you would take with a penny stock. The analogy that I like to use when thinking about a SPAC is this. It's like a group of friends who went out to the taverns and spent a long night out. They get back to somebody's apartment and they're basically tossing some ideas around, where one of them essentially says that, hey, let's go ahead and start a company. Another friend basically says, well, what would the company do? And then the third one essentially says that, wait, we don't need to worry about that. Let's just go ahead and go do a public filing and we'll figure out the details later. Okay, that's like an analogy. Okay, that's not to say that every SPAC is in that regard. Some of these SPACs are done very well, right? They have very robust management teams. They have targets already identified, and they have a pretty good likelihood of closing on these targets. So there are SPACs that do meet that kind of like purpose or definition, but there's lots, and the majority of them, they do not have the same level of sophistication as one would imagine as this minority of SPACs really do. We know what a SPAC is. Let's talk about how does a SPAC actually work. So a SPAC, they have to go IPO. Okay, they try to get into the public markets, and once they try to get into the public markets, they essentially have to file the same amount of paperwork as any other company would. Okay, so they have to file their registration statements, their prospectus, they have to do roadshows, they have to get underwriters involved. So all of that is essentially the same as what any other company would have to do. But the thing to note here is this. Okay, so since they have no defined business plan per se, right? Their filings with the SEC and the exchanges are significantly less than what another company or a private company may have to do in order for them to essentially go public. There's fewer SEC comments, and what that essentially does is it makes the cycle time for these SPACs to go public become a lot faster than what you would expect from a private company. So that is one of the main reasons why there's so many SPACs that are just running out there, and you hear about these SPACs going IPO just about every single day. Second thing to note is that once these SPACs actually go public, okay, and an investor can basically invest in that particular IPO, what happens with your money is that it's essentially held in a trust. Basically hold the money when a combination or a business combination is identified, business combination being when the SPAC is ready to go ahead and buy another company. When that thing is identified, the trust will basically liquidate those assets, and those funds will essentially be used towards that acquisition target. Okay, post the IPO, right, and by the time these management team of the SPAC actually identify a target of a company that they want to effectively acquire, they make an announcement, okay, and that is essentially called the announcement date. This announcement date could be anywhere from like 18 to 24 months out. You definitely want to check out the prospectus to have an understanding of what this time period is going to be. So this is not necessarily to say that every SPAC actually goes ahead and does the business combination, okay? There's lots of these SPACs that do not do so, okay? And when you put your money into these trusts are basically putting your money in very safe assets because they don't want to run the risk of you losing your money, okay? So they will basically be prepared to give you your money back, of course, net of any fees and inclusive of any minimal interest that they were basically able to generate. So hopefully that gives you an idea of how dumb of an investment this is, because you could have your money locked up for a couple of years in one of these types of companies, and you could have potentially realized a better return investing in other equities directly in the stock market. So then the next question is, okay, why are SPACs so popular? Okay, so there's really 3 reasons why SPACs are so popular at this point in time. The first reason why SPACs are popular is that it is beneficial for private companies to utilize SPACs to engage in the public markets. Okay, so what these private companies they do is they basically go through a reverse merger process with the SPAC, and then what happens is they basically consume the SPAC, and the SPAC essentially essentially becomes a publicly traded version of that private company. Okay, so that way the private company essentially now has access to the public markets as well. They don't have to go through the same process as any other company would if they wanted to go IPO, right? And then the third part about this is they're able to maintain a significant amount of control and effectively drive the terms of the agreement with the SPAC, which is also beneficial for the private company. But other reasons why SPACs are so popular at this point in time is that the market is frothy and is filled with a ton of speculative activity, okay? So can you imagine, right? SPACs on average are having a 6.5% run-up on day one after they actually filed their IPO, okay? They haven't identified a business plan. They haven't done an announcement date to determine or to announce to the community which actual company they're even going to buy, but the stock is already running because people are just so hungry for yield and they're willing to speculate so heavily on these quote-unquote penny stocks that these SPACs are essentially running up, okay? And the third reason why these things are so damn popular is because of celebrities, okay? So you have Colin Kaepernick, Shaquille O'Neal, all of these guys who are essentially involved with SPACs at this point in time, and they have whole legions of followers who are essentially also following them and want to get in on some of this SPAC-related activity, okay? So what does the data show? So as I talked about it, right, these stocks are these IPOs are basically experiencing a 6.5% run-up just on the time that they effectively debut. So that's one thing to note. The second thing to note is the CNBC has a top 50 SPACs basically in which they track, and that thing is up about 14% this year itself, 2021 itself, and we're only in February, which shows the amount of market speculation that is potentially there. And $38 billion has been raised on SPAC activity to date, okay, and through Q1 of 2021, and the traditional IPO market has only raised $19 billion. So you can imagine the amount of frothiness that is potentially there as it relates to these SPACs. In all of 2020, only $83 billion was raised, so we're already just about halfway there, and we're only 2 months into 2021. In 2019, there was about $14 billion raised. In 2018 and 2017, there were about $11 billion and $10 billion raised. So you can see how much this market is expanding as people want to get in on some of this SPAC-related activity without potentially understanding what some of these SPACs actually are. But the worst part to note here is that the retail investor is the ones who are driving a majority of the SPAC activity, about 46% of it per Bank of America. And they're buying these things out in the open market, the retail investor. They're not the institutional investor. And as I talked about in prior videos, there's not necessarily an even playing field. The institutional investors are able to get out of these SPACs fairly well, okay? It doesn't necessarily mean that the retail investors do. The institutional investors have access to warrants and other means such that they're basically able to absorb their losses and basically make it risk-free. So what should an investor know? Okay, so the main thing that you should do if you decide to invest in a SPAC is this. Read the prospectus, understand what the targets are going to be, and learn about the management team. That is by far the most important thing that you can do, as opposed to just opening up your Robinhood account or whatever and just buying some SPACs, okay? The second thing that you can do is that know that you can opt out, okay? You can opt out of the business combination. If you don't think that you want that SPAC to essentially go forward with a business combination, whether you're a consultant or not, you can opt out of it and you can get your money back, okay? So that's a very important thing to note. The third thing that you should know, and I've mentioned this before, is that most SPACs fail, okay? They do not acquire anybody, and if they don't acquire anybody, all you get is your initial contributions into that trust on a pro rata basis back, of course, net of any expenses that the management team effectively had to deal with. The next thing we'll talk about is what's next for SPACs, okay? There's a new NYSE rule which makes it a lot easier for private companies to basically invest in this, to basically enter the stock market through a direct listing process. This should significantly make it easier for private companies to enter the market and not have to deal with SPACs in terms of achieving this same outcome. And it makes it a lot better for the retail investor, because the retail investor will know the names of these companies and they will have better line of sight into their business plans, their risks, more comprehensive prospectuses, that they will have a pretty good understanding of what it is that these companies are effectively doing, okay? So that's why we expect to see some level of reduction in the amount of the SPAC activity that we're seeing. So anyway, I hope you enjoyed the contents of this video. If you did, subscribe to the channel, hit the like button, ring the notification bell, and I will see you soon.